You have a number in mind that feels responsible, a retirement target large enough to eliminate worry. For many households, that number quietly lands somewhere north of 5 million. But consider this contrast. A logistics company owner in the Midwest sold his business and walked away with a little over 6 million. One home, one car, commercial flights. His total monthly spending sits around 14,000. When asked what changed after the exit, his answer was simple: mostly my calendar. At the same time, there's a dual income household earning well into the six figures, with under 500,000 invested, convinced even 5 million wouldn't be enough. They've never written down their spending. They just know the number is supposed to be bigger. The issue isn't ambition or discipline. It's that most people assume spending keeps rising as wealth rises. It doesn't. I'm Alex. Today we'll move through real spending behavior across wealth levels, then apply simple math to see why an objectively fantastic life often tops out around 5 million, and why for most households the real number is much lower. And it starts with a pattern hiding in plain sight. Spending tends to stop increasing long before wealth does. Why spending stops long before wealth does. Most people assume lifestyle expands in lockstep with wealth. Double the net worth, double the spending. The data doesn't support that. Households with under 1 million in net worth burn roughly $9,500 a month, move into the 1 to 5 or 5 to 10 million range, and spending rises but only to about $15,000 a month. That jump feels meaningful, but notice what happens next. Net worth keeps climbing. Spending mostly doesn't. Even among people worth 10, 20, or 50 million business owners actively managing real money, the median monthly spend settles around $25,000. Large numbers, yes, but it's not a different universe. It's still groceries, travel, housing, insurance, and dining out, just with fewer trade-offs. Here's the quiet part most people miss. Once the house is bought furnished and paid for, once the cars are replaced with what you actually like driving, once travel becomes comfortable instead of aspirational, spending hits a ceiling. Additional wealth doesn't change daily life much. It changes the margin. It changes stress. It changes how long you can say no. That's why a jump from $500,000 to $1 million feels transformative, while a jump from $8 million to $9 million barely registers. The lifestyle already stabilized earlier. The implication is uncomfortable. If spending plateaus far sooner than net worth, then chasing ever larger numbers may not be about lifestyle at all. It may be about something else entirely, and that realization changes how you think about every target you've been aiming at. A quiet pause before the finish line. Let's pause for a moment and step away from the spreadsheets. Picture yourself 5 years from retirement. Your portfolio quietly crosses a number you didn't expect to reach this early. Nothing dramatic happens, no headlines. Just a larger balance when you check the account. Now, 3 paths appear. One option is to raise the lifestyle. You imagine traveling more often, choosing nicer hotels, maybe upgrading the house. The retirement you pictured expands slightly. Another option is to move the goalpost. You tell yourself it would be irresponsible to stop now. One more promotion, a few more years, just to be safe. The third option is quieter. You change almost nothing. Same plan, same spending. The extra money exists purely as margin. Don't answer out loud. Just notice which option feels most comfortable. That instinct matters, because each choice reveals how you relate to money in retirement, whether you see it as permission, reassurance, or protection. This is where many plans quietly drift off course, not because the math failed, but because the meaning of enough was never defined. And that's exactly where the next part begins, at the point where more money stops changing the plan and starts testing the person behind it. The moment more money stops changing your life, there's a point where more money stops changing how you live and starts changing how you think. Going from 500,000 to 1 million feels real. Decisions get quieter, emergencies stop being emergencies, spending expands because it finally can. That shift is obvious and measurable. But the next jump doesn't behave the same way. Moving from 8 million to 9 million rarely changes the calendar, the house, or the daily routine. The groceries are the same. The flights are still commercial. The lifestyle already stabilized earlier. That's why so many high net worth households look surprisingly normal. No private jets, no rotating vacation homes, school drop-offs, dinner reservations, and routine schedules that look familiar to anyone watching from the outside. One comment captured this perfectly. A retiree planned for 10 million stopped short and asked a simple question: would working 5 more years change the lifestyle? The answer was no, not meaningfully. So they stopped. That moment reveals the real threshold, not a number on a balance sheet, but the point where extra effort no longer buys extra life. Fear blurs that line. Online, you'll hear claims that anything under 10 million is reckless, especially in expensive cities. But fear ignores behavior, and behavior shows that once spending needs are met, additional wealth mostly buys patience. The uncomfortable realization is this: many people aren't chasing freedom, they're chasing reassurance. And those two paths look identical until the moment you decide whether more is actually necessary. Why most retirement numbers are made up. Most retirement targets aren't calculated. They're absorbed. 10 million, 15 million. Numbers repeated often enough that they start to feel like requirements instead of guesses, especially in high-cost cities, where the assumption becomes simple: anything less means risk. But those numbers rarely come from spending. They come from fear. When you ask people what they actually spend each month, the answers are concrete: mortgage or rent, food, travel, insurance, a few upgrades that matter. Then when you ask how much they think they need to retire, the math disappears and the number explodes. That disconnect is expensive. Working backward forces a different conversation. If a household spends $15,000 a month, that's $180,000 a year. Even $25,000 a month, an intentionally aggressive figure, is $300,000 a year. Large, but finite. Once you anchor on spending, the problem becomes arithmetic, not imagination. This is where fear-driven narratives break down. They assume infinite lifestyle expansion. The data shows spending plateaus long before wealth does. When targets are set without reference to behavior, people overshoot. They delay retirement not because life requires it, but because the number feels safer if it's bigger. The uncomfortable shift happens when you realize the goal isn't maximizing the portfolio. It stabilizes the lifestyle. Once that's funded, every additional dollar serves a different purpose. And that raises a quieter question. If you knew your actual spending ceiling, would your number still be the same? Or would it suddenly feel negotiable? What a rich lifestyle really costs. Let's step away from extremes and look at what shows up most often. Among households with net worth between 1 and 10 million median spending, cites around $15,000 a month. That's $180,000 a year. Not modest, but far from extravagant. These are strong earners. Household incomes commonly land between $325,000 and $350,000. Two professionals, or one owner with uneven cash flow. The structure varies, but the spending pattern repeats. Now translate that lifestyle into retirement. Start with Social Security, a combined $72,000 a year, one spouse at roughly $4,000 a month, the other at $2,000. That income arrives without touching the portfolio. To net $180,000 after tax, assume a 30% effective rate. Gross income needs to be about $260,000. Social Security already covers $72,000 of that. The portfolio only needs to produce roughly $188,000 a year. At a 4.7% withdrawal rate, that math points to about $4 million. That number surprises people because it's grounded. It's not aspirational. It's not built on lifestyle fantasies. It's built on how wealthy households actually live. And here's the part worth sitting with. This isn't a lean retirement. It supports travel, dining flexibility and margin, yet it lands well below the figures people are told are bare minimum, which raises a quiet tension. If this covers the upper end of real spending, what exactly are larger targets protecting against? The income stream everyone undervalues. Social Security is often dismissed in high net worth planning, but the math says that's a mistake. At higher income levels, benefits don't scale endlessly. There's a cap on what you pay in and a cap on what you receive. Once you've crossed that threshold, earning more doesn't meaningfully increase future payouts. That's why many high earners underestimate its role. But even capped, the impact is structural. A household receiving $72,000 a year from Social Security reduces portfolio pressure immediately. That's $6,000 a month that doesn't depend on market returns, sequence risk, or withdrawal timing. It shows up regardless of what markets are doing. Remove it, and the math changes fast. To fund the same $180,000 lifestyle entirely, from investments, the portfolio must generate the full amount at a 4.7% withdrawal rate that pushes required assets past $5.5 million instead of $4. That difference isn't subtle. It's an extra decade of work for some people. What Social Security really provides isn't income. It provides insulation. It smooths volatility. It allows portfolios to breathe during downturns instead of being forced to perform on schedule. Even households with seven-figure portfolios rely on it quietly, not because they need it to survive, but because it improves durability. The mistake isn't counting on Social Security too much. It's ignoring it entirely, then wondering why the numbers feel heavier than they need to be. Sometimes the most powerful part of a plan is the piece that looks boring on paper. The real cost of retiring 10 years early. Now push the assumptions to the edge. A household spending $25,000 a month. That's $300,000 a year after tax. Deliberately high, not average, chosen to stress the system. Start with income sources. Social Security still contributes about $72,000 a year. That reduces what the portfolio needs to do, but taxes matter more at this level. To net $300,000 after tax gross income needs to be closer to $460,000, assuming a 35% effective rate across mixed account types. Subtract Social Security, and the portfolio must generate roughly $388,000 a year. That number sounds intimidating because it is. Translate it into assets, and the picture sharpens. Using a 4.7% withdrawal rate, supporting that cash flow requires about $8.3 million. Here's the contrast. That figure represents the upper boundary of a very comfortable retirement, frequent travel, high-end housing, generous flexibility. And still, it doesn't buy private jets or radically different daily life. What matters is why this example exists, not to normalize it, but to cap expectations. If this is the ceiling, everything below it becomes less mysterious. Most people never run this math. They hear large spending numbers and assume infinite wealth is required. But when you anchor the analysis in taxes, withdrawal rates, and real income sources, even extreme lifestyles become finite problems. And once the problem is finite, the target stops drifting. Why retirees quietly spend less over time. Retiring 10 years early changes the math, but not in the way most people expect. The main difference is timing, not scale. For roughly a decade, there's been no Social Security. Every dollar of spending must come from investments. That sounds risky until you separate the problem into two distinct phases. Phase 1 is the bridge, 10 years of full funding. If spending is $15,000 a month, that's $260,000 a year before tax. Because this phase is short and defined, it doesn't require ultra-conservative assumptions. Research shows that over limited time, Horizon's higher withdrawal rates can be reasonable. At a 9% withdrawal rate funding, that 10-year bridge requires about $2.9 million. That pool has a single job get you cleanly to Social Security. Phase 2 starts when Social Security turns on. At that point, $72,000 a year arrives automatically. Portfolio pressure drops. Spending doesn't need to change. The structure does. Now the portfolio only needs to cover the remaining $188,000. That's a different risk profile entirely. This two-bucket approach reframes early retirement. Instead of asking, can my portfolio last forever? The question becomes, can it last 10 years at a higher rate than shift to a lower one? That shift matters. It turns early retirement from an all-or-nothing gamble into a sequence of manageable problems. Most people collapse these phases into one and overestimate the danger. When you separate them, the plan becomes clearer and often more achievable than expected. The math that shrinks the target. Real retirement spending doesn't stay flat. It fades. Early on, money goes toward travel experiences and flexibility. Later, priorities shift, fewer long trips, less frequent upgrades, more time at home. The data reflects that behavioral arc clearly. Modeling this matters because constant withdrawal assumptions quietly inflate the target. After Social Security begins the portfolio, in this scenario, needs to support about $188,000 in year one. Instead of holding that level forever, assume spending declines by roughly 1% per year. That's not austerity, it's aging. Start with a 6% withdrawal rate at Social Security age. To support that first-year draw, the portfolio needs about $3.1 million at that point. Then the pressure eases each year. Look at how the numbers evolve. Year 1 total income around $260,000. Year 5 closer to $253,000. Year 10 about $244,000. By year 20 roughly $227,000. No shocks, no cliffs, just gradual release. Social Security acts as the stabilizer throughout. It absorbs volatility while the portfolio adjusts downward naturally. This is why retirees who plan for flat spending often overshoot. They're preparing for a life that doesn't exist. When you align the model with how people actually live, the portfolio stops fighting time. It works with it. And once spending is allowed to decline, gently longevity stops feeling like an enemy and starts behaving like a buffer instead. Where the number finally lands. The final piece is working the math in reverse. The $3.1 million needed when Social Security begins isn't what has to exist on day one of early retirement. That portfolio still has time to grow while a separate bridge fund is being used. Assume the later life portfolio stays invested for 10 more years. At a 5% annual return, it only needs to start around $1.9 million. At 7%, closer to $1.6 million. Same destination, different starting points. Add that to the $2. 9 million bridge used to fund the first decade. Total required capital lands between $4.5 and $4.9 million. Round it up. Call it 5. That number includes early retirement, high spending, conservative taxes, realistic withdrawal behavior. No heroic assumptions. This is where perception usually breaks. People hear early retirement and imagine exponential risk. But when the timeline is segmented and compounding is allowed to do its work, the math compresses. The uncomfortable contrast is this. Many people are aiming for 10, 15, even 20 million without ever asking what problem they're solving. Meanwhile, a fully stress-tested plan exists at half that level. This isn't about minimizing ambition. It's about aligning effort with necessity. When you see the entire structure laid out, the number stops feeling magical. It becomes mechanical. And once it's mechanical, it can be evaluated, adjusted, or even rejected. That's the moment the chase usually changes direction. Key takeaways. What determines financial freedom isn't the size of the number you chase. It's the structure behind it. When you anchor decisions to spending instead of abstract targets, the problem becomes measurable. Real data shows that lifestyles stabilize far earlier than people expect, even among high earners and high net worth households. Beyond that point, additional wealth doesn't meaningfully change daily life. It changes margin flexibility and timing. Most anxiety around retirement comes from collapsing too many variables into one vague goal. Flat spending assumptions, ignored income streams, and fear-based benchmarks quietly inflate the number. When those are separated by time, by income source, by behavior, the math compresses. The shift is subtle but important. Money stops being a scoreboard and starts acting like infrastructure. Something designed to support a life, not justify endless accumulation. If this way of thinking feels different, that's the signal. It means you're no longer asking how big the number should be, but what the number is actually for.